This video is an intro to indicators and how time frames might affect your indicators. First, let's go over 4 types of indicators. First, there are volume indicators. These focus on volume and volume averages. Second, momentum indicators. These focus on the strength or weakness of a move, up or down. Third are volatility indicators. These tell traders how much the stock has been moving or is moving. And lastly, trending indicators. These help a trader dictate the trend of the stock. Some of the indicators will give signals to buy or sell, and some will just give you important information or more confidence in a trade. You should not and will not use all of these indicators that we discuss in this section. I am giving you this information so that you will be able to understand what other traders are doing and looking at, and so that you can choose one or a few of the indicators to test and use in your own strategy. A lot of traders like to have 1 to 3 indicators and are likely to have them be different types of indicators to balance them out. For example, they might use one trend indicator, one volume indicator, and a volatility indicator. But of course, it's all up to you on what ones fit you. In my own opinion, some traders put way too much emphasis on indicators, and they think they are personally not profitable because of a certain indicator. The problem is not your indicators. Your indicators will always stay constant because it's just a math equation. The markets can do whatever they want. Our indicators cannot. A real problem is if you don't understand how your indicator works, or if you get what's called analysis paralysis, where you have so many indicators on your chart and so many ideas that intersect with each other that you end up never finding a setup or just getting overwhelmed. You can trade perfectly fine without any indicators at all and learn to trade only price action, which some traders actually do that. In fact, price action is probably one of the best indicators out there. Just understanding how stocks move and knowing what is a strong move, what's a weak move, or just what a normal move looks like. With that said, I use a few indicators myself, but have been a victim to analysis paralysis in the past. I'm going to be going over the most popular indicators and ones that I have specifically dealt with. Just because this is the way that I have seen these indicators used does not mean it is the only way to use them. There are thousands of indicators, and each one can be used in many different ways. It comes down to you understanding the indicator or the math equation and testing it the way that you intend to use it. This is where your testing will come into play. Remember, indicators are just math equations, but your time frame might change what data is being put into that math equation. So if you get a certain signal on a 5-minute chart, the signal might look completely different on an hourly or daily chart. Your indicators will likely be affected if you are showing extended hours as well, because then it will add the extended hours data into the math equation. Some traders use extended hours and some don't, so that's something else that you will have to test for yourself. I also want to mention there are some indicators that will remain constant no matter what time frame that you are on. It all just depends on the back end of that indicator. Because indicators might give different signals on different time frames, many traders like to use multiple time frames with their indicators to add conviction to their trade. For example, if a trader has a signal with the same indicator on a 5-minute chart and a 10-minute chart and a 30-minute chart, they may have a little more conviction than if that indicator was only showing on a 5-minute chart. This doesn't mean it will add conviction to your trading, because that takes testing. There are so many time frames that people use. I have seen these time frames actively used: the 1 minute, 2 minute, 3 minute, 5 minute, 10 minute, 15 minute, 20 minute, 30 minute, the hourly, 2 hour, the 130 minute, which is 3 candles in a day, the 195 minute, which is 2 candles in a day, the 4 hour, the daily, the 2 day, the 3 day, the weekly, and the monthly. I have actually seen people using all of these time frames very actively. However, I would say the 1 minute, the 5 minute, the 30 minute, hourly, daily, and weekly are among the most popular. But there are unlimited time frames that people use. This is something else that you'll have to test on your own. Maybe your indicator doesn't work very well on a 1 minute chart compared to using that indicator on a daily chart. You also want to keep in mind that you want the time frames that you use to match up with how long you plan on holding onto that trade. For example, if you're doing a scalp trade, you may not want to be focusing on a weekly chart. Or if you're trying to do a long-term trade, you shouldn't be focusing on a 1 minute chart. Also note that a lot of traders that use a smaller time frame, like a 5 minute or less, will also use a middle ground time frame to confirm an indicator. This would be something like a 30 minute or an hourly chart. And then they will also likely use a daily time frame to look for good levels of support and resistance. Those daily levels are something that most all traders will look at some point. In summary, don't use every indicator that I teach in this section. Pick and choose a few to test out and make sure to line up your time frames with how long you plan on holding onto that trade. We'll dive deeper into helping you choose the correct time frames and indicators in the strategy section. But until then, I'll see you in the next video.